Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. Welcome back, Martin, and you're coming to us again from the iPad. I've adjusted the audio, guys, so I'm hoping it's a little bit better this month.
Hi there. Yes, we're still having a few technical issues that my main studio doesn't want to talk to your studio. So we're using the backup system, but hopefully the audio is a bit better this time.
Absolutely. Well, Martin, any, I guess, general observations from the past few weeks since we last spoke?
It's really fascinating to watch what's happening. So, we've got more economic data, and some of that is relatively negative. Some of it's also a little bit more positive. But what's really struck me is how the tenor of conversation around the housing market has changed in the last 2 weeks. So, for example, CBA has just come out and said, oh, no, there'll be hardly any price falls and it's going to be higher next year. Christopher Joy, of course, continues to argue for higher prices. And some of the other more bearish commentators are also now turning more bullish on prices. So it's interesting to see how fickle the conversation is with regard to particularly property. And I just think that sometimes these conversations are disconnected from the real economy and what's actually happening if you look at the real data on the ground. So I still maintain a slightly more bearish view of what's happening, but we'll see.
Yeah, I guess something that we've pivoted towards a couple of years ago was away from fundamentals, and you really have to start to look at what is going on. And basically, if the central bank is going to print, then a lot of things are going to go up, and that just throws everything traditionally for valuations out the window. And what we saw just this week was the commitment from the Reserve Bank to do another $200 billion. And that is, again, this gets into an argument about where money comes from, but they're kind of giving that money to the banks as reserves. And then people say, well, the banks can't directly use that to speculate. So technically they can't invest. It's just for the lending purposes. But you can kind of rob Peter to pay Paul. And they can say, well, this dollar that was going to go into our reserves, we don't need that there anymore. So now we can use this other money we have to invest and speculate. And that's where we've seen lots of money go into the US stock market from all central banks around the world. So I did a write up just this morning about whether or not we're going to see money printed in Australia find its way into the US stock market as well, because the Swiss National Bank owns billions and billions of dollars of all these tech shares, and it something we've joked about in these episodes before. It'd be nice if we all had a money printer at home and we could go buy some shares or gold and silver or crypto by printing that money out of thin air. So look, I think that's currently where Australia sits. We've started to go down that path because they have to defend the dollar from getting too high. They've been a pretty defensive central bank compared to everyone else. And now Philip Lowe's hand's almost been forced that he has to start doing something. And if all the mortgages go nasty, they're going to buy mortgage-backed securities, commercial mortgage-backed security. So any thoughts on all that?
Well, I think it's interesting that they are, if the AFR is right, there was a report this week that said the Reserve Bank will essentially be asking the retail banks to buy state bonds and government bonds, right, as part of a changed structure for capital. So the committed liquidity facility, which is the old way that they supported the banks, their argument always was, well, there isn't enough government debt around to support the banks, so therefore we'll provide our own. Now they're saying, well, that's different now because, of course, everyone's writing more bonds. So they're throwing a lot of money then indirectly. So it's a round robin way of quantitative easing. It's not the sort of the standard way, right? But I still think you should look across to New Zealand, where I think the RBNZ is probably closer to what's really going on. It's interesting that over there, bonds issued by the government in New Zealand went negative. So in other words, in New Zealand, the government is now raising funds at no cost, which is remarkable. So that's where this quantitative easing takes us. So it takes us to very, very low interest rates. It takes us with the ability to borrow much more. And then the question is, what happens to all that money? Where does it go? Where does it flow? Is it going into the financial markets? Is it going to the real economy? Is it going into lending? That's really now the critical question to watch. And I think you're right. The Reserve Bank here is being forced into doing some stuff. They'll do some more anyway. The other observation, Alex, is the APRA and ASIC positioning with regard to lending. So APRA continues its pretend and extend conversation with regard to there's no such thing as a bad loan in Australia. And ASIC has now said, no, responsible lending? Oh, don't worry about that. Just carry on lending. So in a way, we are in this whole new world where these levers are being pulled. I'm not sure that everybody understands the full consequences of what's happening.
Yeah, and there's probably 2 points that are really important that I want to touch on there, Martin. So even if rates are negative or near zero, it's never been cheaper for governments to borrow. And if you actually take into account real interest rates, it's almost like they can't lose. So they're basically saying, here, take this money, we'll even pay you to take it. But the government, particularly at national level, it's not like they were running a huge debts and deficits. We've got pretty big surpluses here, so they don't need more funds. It's actually about getting them to spend. So this is why the sausage machine that I always joke about, you can keep pushing stuff into it, but it's not going to change if all these other ingredients like tax rates and innovation and incentives to start a business, and none of that is there. So it doesn't matter if you tell state governments to do it or national governments or whatever it is, or the cost of money. None of that is the problem. It's the other stuff in the real economy. And we can keep getting people to build houses and build skyscrapers and roads to nowhere, but that stuff just doesn't help compared to what we need to solve, really. And that's where it's kind of frustrating to watch that this is where it's all going. And yeah, I agree, New Zealand's been way more realistic. They spoke about negative interest rates months ago on money printing, and here it is, and Australia is still denying that it's even really a possibility.
And it's worth just quickly talking about the Fed, right? So the Fed came out a couple of weeks ago at Jackson Hole and basically said, we're going to keep our interest rates lower for longer. Yeah. And what we are happy now to do is to allow inflation to run a bit hotter. In other words, above that 2% target that they were actually targeting before. And the bond markets immediately reacted to that, saying, whoopee, and the price moved dramatically, because that meant that low rates mean that bond prices should be changed. But of course, there's nothing new. That has been said somewhat previously, but now everyone's attuned to it. So another factor in the mix to say rates will be lower for longer. And that does then take us forward into the conversation about inflation or deflation, whether in fact all of this money goes anywhere useful into productive forces, or whether it goes into just inflating financial assets, which is probably not very useful, or whether it sits in savings accounts and all sorts of things, right? But there's no evidence yet of real impact on the real economy. And of course, in Australia and around the world, unemployment looks likely to rise rather than fall.
Yeah, that was I guess a monumental statement that's going to have longer repercussions as we continue to go forward. So immediately nothing really changes, but saying that we're going to welcome higher inflation when real interest rates are already deeply negative. So now you're almost telling people that the cost of goods and that could start to go up even more sharply. But the real economy, your job is going to be maybe paying you sideways or less in real terms because of all that inflation. And that's why these assets like gold are starting to really boom, because people are saying, well, I don't want to lose value and keep falling further and further behind. And central banks are now saying, instead of trying to get that nice cushy 2 to 3% inflation, we couldn't get that, so we've got to try and catch up. So we're going to try and get 4 or 5% as the official rate, which is probably taking the real cost of living up towards 10, 11, 12% a year. And you're obviously not getting that pay rise. Most people are losing their jobs or hours worked at the moment. So it's a kind of nasty mix, and there's no solution or no roadmap out of here like they've kind of been poking fun at Victoria. But there's not like we have this grand plan for Australia to do anything really. That's very frustrating.
Yep, we're in a cul-de-sac and I can't see an exit at the moment.
Yeah. All right, so let's get into it, Martin. You've got close to 10 slides this week, which is great. But we'll start off with mortgage stress, and it has ticked up a little bit. It had been trending down. We thought the top might have been in.
Yeah, so it's 40 point something percent. It's still very concerningly high. And in my surveys, I look at mortgage stress, I look at rental stress, and investor stress, and all three sets of data continues to trend in the wrong direction. In other words, there are more households who are having significant financial flow pressures, and this is, of course, with JobKeeper and JobSeeker turned up to the max, with the superannuation withdrawals also having reached a bit of a peak and now tailing off. And the bottom line is this: that the pressure on households and indeed on businesses is probably more acute than it's ever been, right? And yet now we're being asked to believe that the stimulus should be withdrawn, and essentially everything's now going to bounce back and everything's going to be marvelous. My data is underscoring the risks to households, and those risks mean that in some cases they're paying down debt, and in some cases they're saving more. In some cases they're unable to do that and they're living hand to mouth. And this doesn't bode well for me for future household consumption.
Yes, and you've got the map there of the areas in Victoria.
Yeah, I just thought I'd show this because this really brings it home, right? This shows that the orangey reddy areas are the worst hit, and it's in the high growth areas, and we see it in all the major centres. So where there's been a lot of construction, a lot of high growth corridors, a lot of new people moved in relatively recently with big mortgages. Their incomes are being really compressed. In some cases, job losses are very high. JobKeeper is also very significant in these areas, and so this is effectively an early warning as to where we're going to see downward pressure on house prices, downward pressure on people worrying about their rents and perhaps moving around to other places. So all of these factors need to be thought about. So this is a very important message about this is a patchwork, right? Not everybody is being hit the same. Not all postcodes are being hit the same, but there are a worrying number now of high stress postcodes across the country.
And that data is available on your website, is that correct?
Yeah, so we report that on a regular basis, and there's a couple of shows about it. I'll be putting up some more maps in the next few days, so we'll continue to update the data as it comes through.
Fantastic. So now we've got the stimulus cliff, and we can see the decline from, let's call it 110 down to around 35 or so there. So quite a significant drop off if nothing changes. But what we've seen in the US is political pressure, and eventually they're going to roll something out. So interesting in Australia that we're now in September. What do you think is going to happen here, Martin?
Well, of course, the budget's next month, and I'm pretty sure that they're going to have to announce some additional. So, of course, at the end of September, JobSeeker and JobKeeper rolls back. The JobKeeper bifurcates so that part-time workers get less compared to full-time workers, and the quantum then drops over the next couple of quarters. JobSeeker, the additional amount is also going as well, which means that essentially we're seeing significant withdrawal. So there's more than 20% of GDP in the last quarter. It's about 7.5% of GDP in this quarter. And in the next quarter, it's much, much lower again. Now, the point is, though, that the economy is not bouncing back strongly enough to be able to fill that gap. So the question is, what will the government do? And it's interesting that there have been lots of articles written quoting cases of people in close to destitution even now. And all of the lobby groups from the construction sector through to the airline industry, wherever you look, everybody's saying, we need help, we need help. So it'll be very interesting to see what the government does with its budget. But I'm of the view that they will have to do more for longer, because this is not a V-shaped thing. This is definitely something which is going to go on over the next 2 or 3 years. Remember, the Reserve Bank has always said unemployment high to 10% or more at the end of the year, and probably 7% in 2 years' time. So this is not a simple just withdraw the stimulus and everything pops back to normal. And by the way, of course, the virus is still out there.
Yes, it's a big drop off in quarterly GDP, 15%. And I saw some interesting charts during the week around age groups. And I think it was the 20 to 30-year-olds, one of the youngest demographics who have actually had an increase in their average pay because of how much higher it was than the part-time or the casual hours that they would normally be getting paid. And we've also seen a record amount of people living with their parents since back in the 50s or 60s, whenever it was. And they're the people that are going to be hit the hardest when they've gone from earning more. And they're vulnerable. They're the people that are online. So this is where we've seen maybe in other countries people become more vocal and civil unrest or whatever it may be. But there's going to be people out there that are earning a lot less, that are back with their parents and bored and online, and we need to find something for them to do, I guess.
Well, and that's why all, of course, the conversations about jobs and creating more jobs. But the question is, investing in infrastructure, which of course is a big part of the plan, doesn't ramp up immediately. It takes time for infrastructure to come on stream, and you need particular skill sets to be involved in building infrastructure. And I'm seeing a lot of job losses now in middle and upper management, and those people aren't necessarily that well qualified to go and build tunnels or houses and things. So there is a real question, I think, about the mix of jobs and the distribution of jobs. And I'm seeing more higher paid structural unemployment now, and those people that were in big jobs now being rolled off. And as JobKeeper essentially disappears, as it will over the next few quarters, I suspect we're going to see considerably more unemployment in those groups. We might see some of the part-time work and the casual work and some of the lower paid work coming back, but it's this structural unemployment which I'm concerned about, and there's a very high correlation of that to where the mortgage stress is also high as well.
Yeah, I think we spoke about when this was first unfolding about how other countries were really going aggressively and pulling forward different projects and spending more innovation, and that they were taking this opportunity to say, well, let's do it now. Whereas Australia's attitude was more, I think they said, let's bring it forward. We're going to accelerate it, and it was saying that they're going to take 2 years instead of 3 years now. And here we are 6 months later, where they could have, even if it took 6 months, brought a lot of projects forward and streamlined it all. But here, again, there's still nothing really happened, just sort of hoping that we get a bridge to the other side.
Well, in fact, there was a recent report that showed that there was 20 billion lower investment in infrastructure in the last few months relative to previously. So it's actually going the wrong way at the moment. So all this lip service about more jobs, more infrastructure, it's not actually converting to real work on the ground yet.
Okay, so JobKeeper footprint here. Victoria has obviously diverged from the rest of the country.
Yeah, this is just showing the relative movement from where we were in May forward. So effectively, Victoria has gone up. So there are more people now, not surprisingly, with all the lockdowns. Whereas in some other states like WA, it's going the other way a little bit. The movements, though, are still relatively quite small. So we've got more than 3.5 million people on JobKeeper. That's a big number, right? And if you add then another 2 million or so on JobSeeker, that shows you that a considerable proportion of the population is actually still receiving some support. Now go back to the other slide, right? And that support is evaporating. So the question is, how's this all going to work out?
Yes. So unemployment pressures. Look, the official stats have ticked down a little bit, but these are something that we always kind of question about how it's counted and who falls through the cracks, and if you're working 1 or 2 hours, and it's not the best, most accurate representation.
No, the official numbers are still, below where the RBA says it will be near the end of the year. But the unofficial ones, or shall I say, what I think are perhaps the more accurate ones, the Roy Morgan ones, show that the numbers are really quite high. Even now, they've come back a little bit. But if you add both the unemployed and underemployed, then you've got more than 1 in 5 across Australia effectively in that category. And that's a huge drag on the overall economy, right? And of course, it's massively disastrous for those individual households, but it's also got significant economic consequences. And my own view is that we're going to see unemployment continuing to go higher. I'm looking at small businesses saying, well, we're going to pack up and close down. And I'm still seeing a lot of issues down, for example, the East Coast tourist areas where, of course, international tourism has just died completely. So there are lots of examples where there will be more pressure on jobs, and the hours worked numbers are also lower as well. And we know that the net effect of all this is that there's going to be less money flowing through. So it comes back to the key question: how much will the government fill the gap and continue to fill the gap, or how much will they let the situation ride? And by the way, of course, they've also just extended the protection for people trading insolvent until the end of the year. It was due to the end of September. So we've still got these zombie companies out there. But at some point, those zombie companies are going to have to declare that they are actually not able to continue, right? So that's going to be yet another factor in the mix. This is a really complex thing to try and follow.
Yeah, I think in America we saw the initial jobless claims tick up again. So they're not really trending down, and they're sort of like pushing the, I guess, pain elsewhere. So you can tell the individual that they don't have to pay, or then you can tell the landlord they can defer, and then you can tell the bank that they can put things on hold. But ultimately, if the economy is not moving and money is circulating, someone has to default, or the bank doesn't get paid, or the economy doesn't get that money. So it's you can push it wherever, but at the end of the day, something's got to give.
Yeah, it's a magic pudding that isn't a magic pudding, right? There is actually, at the end of the day, a consequence. And that's what I think. Look, everybody's just hoping somehow that magically the government will fix everything and no one will be worse off, right? The truth is that in an economy that is an open economy, and it's meant to be a capitalist economy, right? There will be winners and losers. But the point is, at the moment, failure is not an option for many businesses. And that means that effectively we're creating all of these zombie businesses. The question is that a really good use of the allocation of capital over time, or should we actually bite the bullet and recognize that we should be constructing new businesses and new opportunities out of the ashes of the old, rather than trying to protect old businesses, perhaps that shouldn't really be allowed to continue. But of course, this is what's happening in the US as well with all the bond purchases, right? So over there, we've got millions and millions of businesses that are still there in zombie mode, thanks to very low interest rates and corporate buybacks. This is not a healthy environment to create future wealth for anybody. And that's the problem. We've got effectively a series of negative feedback loops currently in train, some supports to try and sort of stem the damage, but no real thought about where the levers are to create growth for the future.
Yeah, one thing that I haven't heard many people talk about that I've started to notice is, we talk about this theme of the rich getting richer in terms of individuals, but we're starting to see that in terms of actual businesses, companies in the S&P 500 even. So the smaller companies are really struggling, and they already have debt. They don't want to take on more debt. Banks are more hesitant to lend to a smaller company, whereas these tech giants, they've got huge balance sheets. They've got heaps of cash. They're the ones that can actually borrow more, which doesn't make sense. They're the ones that need it the least, but they can borrow at the best rates. Then they can buy back their own shares. So we're starting to see that they can acquire these other companies, or they're going to, they've got so many choices at their disposal compared to these smaller players. And so the big companies are getting wealthier and the smaller companies are failing. And the government's kind of has these incentives, as you say, to try and keep them all alive, but it doesn't really make sense. But now in Australia, look and you say, well, who are the big companies? We don't have more people that can go and shop at Amazon, or they're not on Facebook or starting a business, anything like that. Our top 10 companies are the banks, the miners, Telstra, those type of things, and they're not the sort of businesses that are going to pick up any slack or get more people using them or spending money on them at all. So it's a very, very different in terms of Australia's businesses, but also the stock market, and the stock market is jammed into everyone's super. So it's this connected cycle where I think money is going to definitely flow elsewhere. And I hear this firsthand from my hedge fund manager friends. They've basically got zero exposure to anything in Australia because there's just no opportunities that they see compared to everywhere else in the world.
Yeah. The innovation cycle here is pretty much dead. And of course, some of the big banks are laying off. One of the banks announced they were closing some branches and effectively, putting more online. We're going to see more of that. So there's an old world problem here in Australia, and we don't really have a new world answer to it. And that's what I've been crying out for a couple of years, in better innovation, better investment for future growth opportunities, not just replicating the previous generation or two, which, worked for a period of time, but it has not led to a foundation for future growth. And that is what we need if we're going to be successful over the next 20, 30 years.
All right, so households are paying down debt, and this is a similar theme we've seen in the US and elsewhere, where people are taking that money, they're saving more, they're paying down debt, but very, very different to what the economics textbooks say, or what the central bankers get up and when they talk about, lower interest rates and that'll spur spending. It's just everything is happening opposite to what they talk about.
Correct. So the first chart from the CBA is just showing that more people are paying down debt, and particularly mortgages, but other types of debt too. So in fact, net debt is dropping, right? And that's quite unusual, as you say, when interest rates are low. But the other side of it is that there are new financial approval numbers were quite a lot stronger this time. And so there's some interesting questions. So there are some people borrowing more, right? But not a huge amount. And if you look at the net growth, business investment is falling rather than rising. There's been some rise in owner-occupied loans, net. Investment loans, not so much, because more people are paying down rather than not. But this is a worrying set of situations where people are saying, well, I prefer just to keep my money. I'll pay down debt because that gives me more flexibility. And the borrowing, unfortunately, I think some people who are borrowing without really understanding the implications of what they're getting into at this stage. Attracted by the low rates, obviously, attracted by some of those teaser opportunities that are out there, but it may not be sustainable. And so some of the analysts I was listening to and watching were saying this could be the last hurrah for lending, and it could go away again. So we'll see.
And do you think that uptick, like what percentage of that is just from some of these incentive programs that we've seen? You know, a lot of our friends and the builders that we talk to, they've just got so much work. So obviously, some people are trying to take advantage of these. The official numbers were quite low. So obviously, those applications haven't sort of flowed through yet. But are we starting to see that with this uptick?
Yeah, so if you go to the next slide, home builder, of course, was one of the elements. So that's the homeland package, or a renovation package. That has had an impact. So we saw a rise in the purchase of land. Now, of course, the issue is that the cost of those purchases have gone up by amount of the additional benefits that were made. So it's a net sum game. And it also takes a few months for those to flow broadly into the economy. So, but the HIA and the other industry bodies were all celebrating the effectiveness of home builder, and you can see it in the numbers here. But the question is this actually a good strategy? Bearing in mind we've got 1.2 million spare properties in Australia already. Bearing in mind that we've got several 100,000 in construction at the moment, particularly some of those high rises that are half built in our major centres. So it's not like we've got too little property. No. There's too much property. And yet we've got people who are being cajoled into the market to go buy homeland packages. And by the way, putting up the prices of those and differentially reducing the price of existing property in and around the same areas. So there are consequences which are not well understood from these government policies, which I still think are myopic.
Yeah, no, I definitely agree. And before we get into the loan deferral statistics, I'll probably say that it's another example of the short-term thinking, and whether it's the 3-year election term in Australia or whatever it is in different countries, you can pull forward that demand for housing, but you've already pulled it forward from another generation with your last scheme. And then you can make it slightly bigger, and maybe you'll pull forward another year or so of younger people that were thinking about it. And you can defer their mortgage until regulators can say that, no, that doesn't count as a delinquent loan or whatever. So you can sort of pull all these things forward, and then on paper you can say, aha, see, things are okay. But this all has to sort of come undone or unwind, or people like it when I say water finds its level and balance is restored. At the end of the day, it does not change anything, and this can make it worse like next year or whenever it is. So that's why it's very frustrating when we sort of hear and see these things.
Yeah, and remember, of course, that people are still banking on having a job, right? And if the unemployment rate is going to go higher, it could be that some of these people who've just committed to these loans will suddenly find that they can't complete, or that they're unable to service the loans. So we are building up risky strategies for later. And it is short term versus long term. It is what can get us to the next election rather than what's right for the longer term prosperity of Australia. And I think those two sets of questions should be turned around and say, forget the election. Frankly, the critical decision now is what should we be doing to set Australia up right for the next 20, 30 years. And the strategies would be different, I think, if that was really the agenda.
Yeah, I might share some ideas on that at the end, Martin. But do you want to talk us through any of the interesting points here in the loan deferrals? Yeah,
well, just quickly, so APRA released their loan deferral data, and basically there's 9% of loans deferred at the moment. There has been some comeback, in other words, people have started to repay. But interestingly, about 17% of SME loans are still deferred. 17%, that's a big number, right? And we also know from the analysis that a considerable proportion of these loans are interest-only loans. A considerable proportion are actually for investment purposes, about 34%. And it also shows, if you look at the individual data from APRA, that not all banks are doing it the same way. So, for example, CBA basically automatically deferred SME repayments, right? So they've got a much higher representation of deferred loans relative to some of the other banks, whereas people like Westpac or Bank of Queensland has a higher proportion of mortgage deferrals because of their portfolio and because of their approach. So it'll be interesting to see how this plays out. My worry, though, is that this is a quantum of deferrals which is having a significant impact on the individual banks. So effectively, they're accruing a lot of income and capital, right? Simply because those loans are not being paid down. So the loan balances are automatically rising. And the other point, of course, is that APRA has also now basically extended the don't worry about defaults and you don't have to report them as defaults until March next year, right? Which basically means that they can keep the default rates really low. So again, it's another example of intervention in the market to distort what's really going on. Now, this may work out right if people get their jobs back. But what happens in March when effectively this deferral period stops and we've still got all these loans that actually have not caught up? What do you do then? Do you just kick it out further, or do you actually deal with the consequences? And of course, the banks are actually being proactive and beginning to start talking to some of these borrowers and suggesting maybe you should sell. And Ross McEwen from NAB 3 weeks ago said, look, there will be some people whose best strategy would be to sell now because ahead it's going to get worse. So we're in this sort of weird twilight zone, right, where effectively the normal rules of lending and the normal rules of how you report capital and how you report risk are all being obfuscated by what APRA is doing. But I worry that we perhaps are, again, building a problem just a bit later. So it's a short-term fix only.
Yeah, and it's those younger people, like we said, that have got the bigger loans and the bonuses and the incentives that are probably going to have the highest unemployment rate and the next lot of job losses and move back in with their parents and that sort of thing as well. And yeah, if confidence is down, then businesses don't spend and invest, and it all ties together.
Yeah, and the next slide is all about consumer confidence, business confidence. Now, Westpac's latest data showed there was a bit of a spike up in consumer sentiment, right? It was very low previously and it's come back a little bit. And some of that is that it was really low and bounced back. And some of it was the fact that some of the news is better with regard to the virus and, people worried about New South Wales and that looks as though it's probably a bit under control now. So that might be a good sign, but it may only be temporary. But the business index, look at the PMI, the Purchase Managers Index, or look at the business confidence indices, they're very low. Businesses are not borrowing at the moment because businesses are concerned about the future. And that's my real concern, is that unless we can get businesses to start to actually understand there is a landing point down the road, this is not going to actually enable the economy to come back where it should be. So I'm really worried about businesses, a lot of small businesses. And there was a loan scheme which basically money came from the RBA to the banks to lend to the business sector, right? And it was quite a big number, but almost none of it has actually been lent because businesses are unwilling or unable to take those loans. So it's another example, again, if you can create all these wonderful facilities and you can, say, here's some money, go borrow. But if the consumer or business confidence levels are too low, it's meaningless because people won't follow through.
Yeah, I think the stat was something like 70 billion pledged, and maybe like 1 or 2 billion went to small businesses, and the rest went to the big guys, like we were just kind of talking about in the US as well. So
yeah, and of course the other thing about JobKeeper, if you look at some of the big firms, they really benefited from JobKeeper. Some of the retail firms actually made super profits and handed out bigger dividends because they were able to actually capitalize on JobKeeper. A lot of JobKeeper didn't flow down to small businesses, the people that really needed it. That's one of the reasons why I would argue that rather than just extending JobKeeper, they need a different structural solution to help those 2 to 3 million small businesses through over the next few months, because they are effectively the economic future of the country.
Yes, completely agree. GDP down, household savings ratio up. We've spoken about that a little bit already, Martin. Anything else to add?
Well, just to underscore, big drop in GDP. That means that next time, if GDP is up a little, the percentage move will be very big, but don't be deceived, right? Because you need a bigger number on the way up than you do on the way down. That's just how maths works, right? So that's the first point. The second is, of course, that the savings ratio went up massively high. And if you include superannuation, other things, it's 24% up. So it's a remarkable number. But again, it's all very artificial, right? And so none of this data really tells you very much at all about the state of the economy. And yet, economists spend a lot of time talking about GDP and savings ratios, and I would simply argue that sometimes data tells you nothing at all.
Yes. What I would just add quickly there, it's just the velocity of money that we often talk about. So when the GDP is falling, the size of the economy is shrinking, but then people, any money they have got, they're sort of saving or paying down debt. That's also pulling money out of the economy. So you can think of that GDP as a pie, and it's just getting smaller and smaller, and that's why it's harder for it to expand again.
Yeah, absolutely. That's right. And we need different levers pulled, in my view. And by the way, the last slide is that around the world, we had this big drop because of the virus, and we started to come out of it. But it looks as though the growth is plateauing at a lower level than where we were, and pretty much every country that you can see from this chart is in the same boat. So we're coming into an economic environment, despite the ultra low interest rates and all the money printing, that looks as though it's going to be harder to actually create momentum going forward. And I suspect that really underscores the fact that some of these strategies really are not very effective in terms of actually laying the foundations for future growth. And I keep coming back to, we need a different recipe, right? We can't just go back to what we did previously. We can't just throw a bit of money at it and hope that the private sector will pick up the slack. This is a much, much more structural and critical set of issues that we need to address, but we have to address it differently if we're actually going to be successful, because just replicating what happened the last 20, 30 years is going to take us into an even higher debt universe, which is even worse for households and businesses. And it will actually suck more value up to the top end of town and create more distortions in the economy. And there will be a smaller pie going around, which means that, of course, jobs will be very much at a premium and incomes won't grow at all. We need a different formula.
Some of the things that have been floated that are a bit more, out there and different, and those things probably aren't going to be tried. But anyway, some things that I've heard that, Steve Keen's debt jubilee of wiping the slate clean, because it's just, you're never going to get growth with record household debt. Other things I've heard is that idea of the universal basic income and pay everyone a pretty decent wage and try and get the velocity and spending going. I kind of like the idea of somehow trying to tax the wealthy, I guess, more, or maybe the lower income less, I should say, in a way that it's fair. And so how do you do that? Maybe you scrap income tax altogether, and then you just do like a GST or a spending tax. So if someone's super wealthy and they're spending a lot, that's kind of getting taxed and funding. Whereas if someone's trying to save up as much as they can and they can't afford to buy much, then they're not getting taxed too much either. So I think these are some of the experiments in the modern monetary theory. All these things are sort of floating around, and people are kind of need to think about these, because whatever we're doing and trialing has not really been working. The other thing I'll just say is in terms of the virus, I think we've got some more data that's come out, always changing, and it's very different to what we thought initially when we were very cautious and, we saw Italy and New York and it was kind of worrying. Now we're starting to say, well, hold on, if Sweden didn't have it too bad, why is that? And, is it something in their demographics or their diet or their genetics? Could that be the same case in Australia? And should we be in this complete lockdown if the case numbers are relatively low? And I know it's hard because medically you need to be responsible. And people that are saying it's not that bad or whatever, that's all well and good to think that. But if you let everyone out and then we do have an Italy or New York, that is just catastrophic. So more data is coming in. I certainly think that we are not having the right conversations now. Then there's medical professionals that are kind of, you can see that they're along the same train of thought as I am. We've got 500 doctors or whatever it is saying, we need to be starting to try this, that, or the other, or think about this. Whereas the conversation a week or so ago was, there's not even a roadmap in sight. It's just lockdown until we get down to less than 5-10 cases, which is almost impossible. So I think that if we look at these other countries and we can say, well, hold on, why isn't it that bad? Do we open everything up as long as people, do the masks, the hand washing, and we're more cautious about elderly or whatever it is? So look, I'm not saying that it's not dangerous, because we have seen what it can do, but I'm saying there's obviously places now that haven't been too badly affected. So we need more data. Why is that? Some of the most promising vaccines obviously had big setbacks again this week. And that was another thing that I was saying, I think it's a year or two away, and everyone was saying, oh no, everyone in the world is working on it. It'll be here in 3 to 6 months. And here we are 6 months later and we don't have one.
Yeah, it's a wicked problem, right? Because effectively you've got an economic issue and you've got a health issue, and essentially you've got to try and manage the two. But I agree. I think the data is showing that there's some interesting alternative ways of thinking about it. But I come back to this fundamental point, Alex. At the moment, we do not have capitalism working, right? All of the interventions from central banks, all of the support of businesses that should have failed, all of those things are basically propping everything up, right? And my concern is that unless we actually stand back and think a bit more creatively and strategically about how we deal with the health issue, how we deal with the economic issue, how we deal with central banks and, monetary targeting, all of those things. Because at the moment, I have to say that suite of policies together are failing us. And so my plea is for some different thinking and alternative views to come through, because I think we need a different way forward. But, unfortunately, there's an election, and of course, it's all centered around the election, unfortunately, rather than thinking more strategically. But there you go. I'm going to continue to strategically think, because I think that's the way to do it.
One more thing I do want to add was we've sort of predicted for a couple of years now that it's no different in Australia than other countries. And when we see financial strain, we're going to see civil unrest. And we've started to see that just this week. And it's also, I think, because of the frustration and whatever of the lockdown as well to some degree. But that is something that I think we need to be aware of. And if it gets worse, there are going to be... Another thing we kind of joked about was places like Tasmania or rural locations might start to garner a premium, or New Zealand if there's more freedom. If a place that's a 45-minute plane ride away is in stage 4 lockdown, or you can go to the beach in Tasmania over summer, we are seeing house prices right near their highs, if not growing here in Tassie, which I kind of joked about maybe that would happen, and I'm kind of shocked that it is happening now. So people are going to want to go to places where there are more freedom, let alone if there's also civil unrest or other things there as well. So something to keep in mind, however unlikely it is or likely, just to prepare for all possible scenarios.
Yeah, and a great point, Alex. And again, I think, you've got to question your fundamental assumptions, because some of those assumptions probably are changing. Great to catch up again.
Thank you. Cheers, guys.